Hello, my name is Stella Amos and I'm an international tax partner here at PwC, and today we're going to be talking about Action 4 of the BEPS process, and it's looking at interest deductibility. I'm joined today by Neil Edwards and Mike Cooper, both of whom also work within the international tax practice here in PwC. So Neil, without further ado, can you explain the background to Action 4 and this paper?
Well, Stella, the background is the OECD have identified interest as one of the big key risks associated with base erosion and profit shifting. And what this paper looks to do is consider where there should be restrictions on interest deductibility across multiple territories. As we know, the UK at the moment has had relatively generous interest deductibility rules, and these proposals could have quite a significant impact on that.
So broadly, and as high level as you can, because I know it's quite a chunky paper, what does it actually say?
Well, the paper looks at a number of different ways at which interest restrictions could be introduced, and it considers a number of measures which already exist, such as withholding tax and transfer pricing and so on, and largely says that those are not sufficient restrictions on interest. And so what the paper ends up proposing is really three possible options, the first of which is a worldwide allocation rule, by which they mean take the overall external interest expense of the worldwide group and say each territory should have a cap on the interest they can deduct based on their fair share. So it might be based on their proportion of earnings or something to that effect. So that's one alternative. The other alternative is a fixed ratio approach. So much like the existing system we have in Germany, for example, which might say each territory can only deduct 30% of their EBITDA by way of interest. And then there's a third proposal, which is basically a combination of those two. What they would have is a very low level fixed ratio, effectively almost like a safe harbour for people which have got relatively low levels of interest and so don't have to apply the more complex rules. But for everyone else, they would then be into the worldwide interest allocation rule.
Okay, and so then just generally, what would the consequences of those kind of restrictions be?
Well, I mean, the consequences would be quite significant because groups at the moment are largely able to put their debt in different territories wherever they need to, whereas the effect of these rules coming in would mean, particularly if it was a worldwide allocation rule, which does seem to be the favoured approach, some quite significant restrictions on interest deductions and great difficulty in groups actually managing to allocate their debt around the group in the worldwide group in a way which doesn't lead them suffering double taxation. Okay,
they're pretty significant then.
Absolutely.
So Mike, so who's likely to be impacted by these proposals?
Well, I think that's one of the things here is that the potential impact is huge and very broad. Almost anyone with external debt or internal debt is going to have to think about how these rules might apply to them, unless perhaps they just operate in only one territory where things will be more straightforward. I think those particularly affected are going to be those groups where they have very little external debt but maybe substantial amounts of internal lending within their group, or those that have got significant external debt at the parent level and haven't been able to or haven't chosen to push that debt down into the local operating subsidiaries because they're unlikely, if these rules come in, to be able to sustain all of those deductions at the parent level.
Okay, and what's the most kind of practical impact of these changes going to be for business?
Well, there's the obvious one, which Neil has alluded to, which is just the loss of the deduction and therefore an increase in the effective tax rate of the group. But I think there's a knock-on effect of that people will need to start thinking about soon, which is it can affect your decision-making. So if you were going to go out and buy another group or another company or even an asset, and you're going to fund that with external debt, if you can't guarantee that you're going to get the interest deductions for tax purposes, then it increases your cost of borrowing and you may not be able to afford to pay as much for that asset as you otherwise would, and it might therefore make you less competitive against as compared to some others. Probably a secondary effect that is worth noting, maybe not an effect on the company, but one to think about when looking at the regime as a whole. If these companies are not getting deductions on all of the interest, but presumably the third-party lenders are getting taxed on the income, then in effect we're getting double taxation. And from a policy perspective, that's going to be an unfortunate consequence if these rules come in.
So with all that in mind then, Neil, what's the likely kind of response from business and companies going to be?
Well, I expect there could well be widespread concern. I mean, I think the impact of this is going to run, as Mike has said, across huge numbers of companies, and the fact that they're likely to move from a position of generally being able to obtain interest deductions to almost certainly in many cases not being able to obtain a deduction for their external cost of funding will have a real knock-on effect on competitiveness and investment and cost to them. And that's before we get into the compliance burden of all the different territories attempting to adopt rules like these, which is likely to be very, very difficult.
Okay, so bearing in mind that kind of impact, then what is the timetable that we're looking at here?
Well, so the paper has only come out in draft, and it's important to note that the final paper is not going to be released until sometime later this year, likely towards the end of that year. And it will then really be a question for individual OECD states to decide whether they want to adopt it within their local law or not. I suspect, given the complexity of these proposals, there is likely to be some element of lead time necessary to bring in legislation that can cope with these arrangements. But it's entirely possible by, say, 2017, 2018, these proposals could have been adopted in a number of territories for sure.
Right, but there's presumably, given that this is the first draft, there's work to be done before you get to a point where legislation can be implemented.
Yeah, absolutely. There's still work to be done, but nevertheless, the direction of travel associated with these proposals is reasonably clear, and certainly it's possible now to take some kind of reasoned estimates as to what the effect of the proposals could be. And I think it is important for anyone undertaking a transaction now, in terms of an acquisition or whatever it might be, that's naturally going to make assumptions post 2017, 2018 to at least understand what the worst case scenario would be if these proposals were introduced.
Okay, so picking up on that then, Mike, what are the kind of three key elements that people need to be taking away from this as to what they can do now?
Okay, well, yeah, to pick up on Neil's last point, in fact, assessing the impact has to be one of the first things you need to do. Now, it's very true that these rules may change a bit over time, but we have, as Neil says, a fairly clear idea of the direction of travel of the preferred types of restriction that are going to be put in place. And so you can do some modelling, and that can help you understand what your worst case might be, and I think it's worth being aware of that. It also might help you identify the areas where you might most likely be affected, so the particular territories where there might be particular tensions if these rules were brought in. I think that's important. Having done that, I think the second thing would be to make sure that you think about who you should share that with. Should you be telling the CFO, the board, so that they understand that? Because the third thing would be to start trying to factor this into some of your long-term decision making. If you're in an industry particularly that has to make long-term investments, and we can all think about oil and gas infrastructure type projects in particular, but more broadly than that as well, you need to think about this when you start making those longer-term decisions. Okay,
and then I guess the final point is this something that businesses can make representations on, and if so, is there a timetable for that?
Yeah, they absolutely can. I think we'd encourage them to do so. Early February is when they would need to be in, so there's still time to do it. And I think if you, when you look at these, think that you're going to be materially affected by them, or maybe, then I think you should be letting the OECD and your local tax authorities know that, because even if the direction of travel is clear, there's still time to influence some of the detail, and there's still time to influence how these rules might be implemented locally.
Right. Great. Neil, Mike, given the significance of everything we've talked about and how kind of wide-ranging these rules could be, thank you very much for that update.